Welcome to the Wealth Beyond Debt Show. I'm your host, Leah, and joining me today is my insightful team member, Jalal. In this episode, we're discussing 8 principles you must know before buying a home. We'll explore the latest trends in mortgage rates, the increase in housing inventory, and the importance of understanding government policy changes that can impact your home buying journey. Plus, we'll touch on affordability challenges and the growing demand for suburban homes. Let's dive in and equip you with the knowledge you need to make informed decisions when making such a large investment for your home. Welcome to our discussion on making home buying in 2025 not just a dream, but a planned reality. We've got 8 key principles to explore that can genuinely shift your approach to buying a home.
I'm really excited about this. What's the first principle that we should dive into?
The first principle is starting with financial readiness. It's all about checking your credit score and your debt to income ratio because those figures really determine your mortgage approval chances.
Yeah, so basically, if you've got a high credit score, you could lock in a lower interest rate, right?
Exactly. For instance, someone with, say, a 760 credit score might secure an interest rate around 6%, while a score of 650 might push you closer to 7.5%. That difference really adds up over time.
Mm-hmm. And that sets up your financial foundation well. So what's next after checking your financial health?
Next is saving for a strong down payment. It's like your launching pad. You get to choose how much you put down to avoid extra costs like private mortgage insurance or PMI. Now, most folks think 20% is mandatory, but there are options that bring it down to, you know, 3.5 or 5% through FHA or VA loans.
Right? But I imagine even if you choose a lower down payment, you might end up paying more interest over the life of the loan, correct?
Precisely, and that's the trade-off. Smaller down payments lead to higher monthly costs and total interest. For example, on a $400,000 home, a 20% down payment is $80,000, while 3.5% is just $14,000.
Yep.
But then your monthly mortgage could be much higher.
So it really comes down to balancing how much you can put down up front with how much you want to pay over time.
Absolutely. Now, moving on to principle number 3, which is knowing your mortgage options. It's about understanding the differences between traditional closed-end loans and more
Hmm.
flexible tools like open-end loans or lines of credit.
And closed-end loans mean that once you borrow the lump sum, it's fixed, correct?
Yes, exactly. With a fixed-rate mortgage, your payments go through an amortization schedule where initially a major chunk of your payment goes toward interest rather than
Yep.
reducing the principal.
And open-end loans, like HELOCs, give you a bit more flexibility, allowing you to borrow and repay repeatedly.
Right. That kind of flexibility can be a game changer if you're using your money strategically to reduce debt faster rather than locking it into a one-time
Interesting.
borrowing.
But isn't there a risk that too much flexibility could lead some people to overspend? I mean, the control has to remain in your hands, right?
True, and that's a fair challenge. It's like having a powerful tool. You have the potential to do a lot of good, but you have to use it wisely. The key is using that credit to leverage savings rather than creating extra debt.
Mm-hmm. Got it. It's about the smart use of available credit. What principle comes after understanding mortgages?
Principle number 4 revolves around the power of interest awareness. Most homeowners don't really see, but over a 30-year mortgage, interest can literally drain half your payments. Think about it. On a $400,000 mortgage at 6%, over $460,000 in interest might accrue over time.
Wow, that's wild. It really flips the script on how we see mortgage payments. So, what can someone do about this?
That's where interest cancellation comes into play. Making even a single extra principal payment per year could shorten your loan by several years. Even an extra $200 monthly can be like um, dropping money into that proverbial magic box that saves tens of thousands in interest over time.
Right? It's pretty much like accelerating your financial freedom, isn't it?
Exactly.
Debt weighing you down? Time for a breakthrough. Our Debt Crusher software eliminates all debt quickly, no refinance, no consolidation. Since 2004, over 2.8 billion eliminated. We have helped thousands become debt-free from mortgages, credit cards, auto, student loans, and more. At Debt Free Made Easy, it is fast, simple, life-changing. Click to learn more and start your debt-free journey today.
Now, moving forward to the fifth principle, we have offset accounts. Essentially, these are savings accounts linked to your mortgage balance, reducing the amount on which you pay interest.
So, for example, if you owe $300,000 but have $20,000 saved in an offset, you're only charged interest on $280,000?
That's exactly it. This can save you a significant chunk of money over the life of the loan. It's a clever way for the bank's own mechanisms to work directly in your favor.
Yep. Now, how does the sixth principle build on these ideas?
Principle 6 is all about float and leverage. This is the smart use of credit that many people overlook. When you use, say, a credit card for everyday expenses and pay it off before interest kicks in, you actually give your money a little more time
Right?
to work for you.
So instead of just spending cash directly, you're basically allowing your money to enjoy a kind of delayed payment period, which helps reduce interest costs?
Exactly, it's like your cash is having a little vacation, earning interest while you take advantage of the credit card's float time. And if you extend that concept through a HELOC or a structured financial plan, you really start to see the cycle of leverage work in your favor.
I can see how that strategy turns credit from a potential trap into a powerful tool.
Right on. Next up is the seventh principle, strategic debt payoff, sometimes referred to as the financial GPS.
Yeah, that's an interesting term. How does that work exactly?
It's like having a roadmap for your finances. You enter your income, expenses, debts, and the financial GPS, developed by experts like Debt Free Made Easy, maps out the fastest route to financial freedom. It adjusts as your situation changes, ensuring your payments are always working smartly against your debt.
Exactly, it's adaptive. But couldn't some argue that such systems oversimplify the complexity of personal finance? I mean, not every situation fits a standard map.
That's a fair critique. However, while personal finance is inherently complex, having a structured system can at least offer a clear starting point. It's like using a GPS. You may encounter detours, but having one beats navigating blindly.
I see your point. The system isn't perfect, but it certainly streamlines decision making.
Exactly. And that brings us to our final principle, the real life example of the Jones family. Their story really ties all these principles together in a tangible way.
Right? They bought a $400,000 home at a 6% interest rate, right? And then they used a HELOC as an offset, made extra payments, and really leveraged their discretionary income?
Yes, indeed. The Jones family managed to cut 17 years off their loan and save over $180,000 in interest by applying these principles. Their journey, in a nutshell, shows how these strategies can transform debt into wealth over time.
Wow, that's a powerful example. So the big takeaway is that buying a home in 2025 isn't just about property ownership, it's about mastering the financial strategies that let you control where your money goes.
Absolutely. When you understand the dynamics, credit health, down payments, loan types, interest management, and strategic debt payoff, you're not just buying a home, you're building a future of financial independence.
Yep, that's the goal. And all of that means transforming what could be a heavy debt burden into a stepping stone for wealth building.
Exactly. By planning your finances, leveraging smart interest strategies, and using tools like offset accounts and the financial GPS, you're turning debt into a tool rather than a trap.
It's really empowering to see that, with the right approach, buying a home is not just a purchase, it's a pathway to lasting wealth.
Totally agree. When you combine preparation, discipline, and strategic planning, 2025 can be the year you break free from debt and truly own your future.
You won't believe what I just found out. Check this out. My neighbor asked me a few days ago, "Are you paying off your mortgage the old school way or the new way?" I said, "What you are talking about?" He tells me the old way, 30 years of mortgage payments with over $300,000 just in interest. Or the new way. There is a financial program that Debt Free Made Easy offers, which enables anyone to pay off their 30-year mortgage in just 5 to 7 years and save more than $190,000 in interest. Really, yes, I am for real 100% guaranteed. Here's the best part. There's no refinancing, no changes to your budget, and no changes to your lifestyle. Incredible. I was curious, so I checked it out for myself. The results? My 30-year mortgage and all my other debts will be completely eliminated in just 7.4 years, and I'll save over $219,000 in interest, which goes back into my pocket. I will be debt-free and living life on my own terms. Listen to me. If you're trapped in the old way, see how much time and money debt-free made easy can save you. It's quick, easy, and life-changing. The banks do not want you to know this, but don't let them know I told you. The secret is out. Scan the code or click the link below and start getting some of this money back today.
Thank you, Leah, for such an insightful discussion today on the Wealth Beyond Debt show. We hope you found our exploration of the must-know principles before buying your home valuable and informative. A big thank you to our audience for tuning in. If you enjoyed this episode, please like and share it to help others on their journey to financial empowerment. We'd also love to hear from you. Feel free to comment with any topics you'd like us to cover in future episodes. Together, let's continue to expose the banks, build a community focused on achieving financial freedom, and put money back into your pocket.